Welcome, listeners and market participants, and welcome to KBRA's European Credit Podcast, Conversations in European Credit. I'm Gordon Kerr, Head of European Research at KBRA, and today I am joined by Gabriele Gramazio from our European Structured Credit team.
Ciao, Gordon. Thanks for having me again.
Today we will be covering the topic of a recent report on the CLO market titled European CLOs Too Big to Hold. The report can be found on kbra.com along with our other recent reports on the amortization of CLO transactions and manager behavior. Further, you can find our popular manager style reports, which we have been producing for a number of years. And now, large borrowers have utilized the leveraged loan market in Europe during the period of low interest rates prior to 2022. As a result, collateralized loan obligation exposure to single names and the idiosyncratic risk associated with a single borrower has recently become evident in the case of a specific corporation called Altice. It's a telecommunications provider and a large borrower active in the leveraged loan market. The company made extensive use of the European leveraged loan market as a part of its almost 25 billion euros of debt outstanding. However, Altice is not the only large borrower in the CLO market. In this episode, Gabriele and I will delve into the CLO market and the large borrowers that make extensive use of leveraged loans. Gabriele, let's get to it. For starters, let's discuss how we arrived at our current situation. Between 2016 and 2022, obligors in the European high-yield market increased their indebtedness to levels not seen since the years leading up to the global financial crisis, helped by strong demand for high-yield loans and historically low interest rates. Average debt to EBITDA multiples for European speculative-grade companies reached a peak of nearly 6 times in 2020. This allowed high-yield obligors to successfully negotiate increasing flexible terms in loan documentation, reducing lender protections, and weakening the overall security package.
Yeah, indeed. This gave Altice the ability to threaten lenders with a haircut on their debt, given their decline in revenues and the elevated borrowing costs. So what happened in March 2024, Altice made an announcement from the company controlling shareholders that lenders may be faced with a haircut on their transaction as the revenue of the company were declining and the company facing pressure from elevated interest rates.
Yeah, so let's just quickly get into the rates and their impact on leveraged borrowers. When the European Central Bank aggressively increased interest rates, it more than doubled the cost of debt for leveraged borrowers.
Yeah, look, Gordon, average 3-year leveraged loan yields increased to 11% from 4% and have subsequently fallen to about roughly 8%. Now, most leveraged loan borrowers make use of floating rate loans, so they would have felt the impact of rate rises on their cash flows, and this places pressure on margins and profits. In the report, we look at an example of the impact of rate rises and margin compression on available cash flows using a sort of hypothetical company. So even with revenues kept steady, the impact of yields rising to 8% from 4% could cut free cash flow yields for our hypothetical company by more than half. In addition to the higher cost of debt, the compression of EBITDA margins is possible as inflationary pressures challenge cost control. Materials and wage costs have increased as inflation has impacted company supply chains. Some companies have passed on price increases, but others have struggled too, as highlighted in the KBRA research report that we have been writing about corporates. These would drive free cash flow down, and as with our example that we have been showing in the report, a decrease in EBITDA margins added to higher cost of debt can fully eliminate any free cash flow from the business. Such are the pressure facing companies both within Europe and in the US.
Yes, and as CLOs are exposed to companies across a broad spectrum of many different industries, the largest amount of lending in the European CLO market is to the chemicals, containers, metals, and materials industry. This is largely supported by one of the longest standing and largest companies in the leveraged loan market, INEOS. But what are the other sectors that dominate the CLO market?
Yeah, we have outlined this in our report with a nice chart. But again, for our listeners, the next largest industry are consumer retail, commercial and professional services, and pharmaceuticals and biotechnologies. So these sectors, plus the chemical sector, as you mentioned, dominate the leverage loan market in Europe.
So, where do we see the most stress and risk of margin compression then?
Well, entities that operate in sectors that have traditionally been regarded as defensive, such the case of Altice in the telecoms or Thames Water for utilities, are experiencing deterioration in performance due to their weak capital structure, often combined with material capex commitments in the context of higher for longer interest rates. Consumer retail will have recently faced inflation related pressures owing to the difficulty in passing on increasing cost. Further, certain companies within the chemical sector may have also faced challenges due to the increased energy and feedstock costs associated with the Russian Ukraine conflict. However, a varied industry exposure helps managers to diversify their risk as companies in some sector come under pressure from some of these factors.
Agreed. Now, let's turn to the main focus of our investigations in the report and back to the Altice story. The impact this large borrower has had on the market highlights the risk to the market of large borrowers potentially defaulting. For starters, can you highlight for us how the CLO market protects for these large borrowers?
Yeah, sure. Look, typically CLO transaction, they limit the three largest obligors to 3% of the collateral pool and are normally required to be first lien loans. After the three largest exposure, the limit generally falls to 2.5% or lower, depending on the seniority of the instrument and obviously the limits stated within the CLO documentation. European CLO portfolios have a large degree of overlapping across the market for collateral. However, individual managers and CLOs will have differing exposure to the larger names previously outlined. So we were curious about the level of exposure manager have to some of these large names. So we took a look at the market and defined the largest 20 entities held within the CLO portfolios. Should be noted that these are borrowing entities and not parent entity companies. For example, two of the 20 largest entities are Altice companies, which are Altice Finance and Altice France.
Okay, and so what did we find with regards to these large entities?
A CLO with exposure to the top 20 entities vary in total amounts held within each portfolio between 15 million and 123 million. The total aggregate exposure within a European CLO to the largest 20 borrowers in a portfolio can range from roughly 7 to 25%. However, the bulk of CLOs hold roughly between 50 to 75 million from the largest 20, averaging about 59 million. These represent between approximately 12 to 18% of the portfolio, with an average of 15.5%.
Interesting. And was there any work done to determine what this looks like at a manager level?
Absolutely. So, aggregating the amounts of the large borrowers held by an individual CLO manager within their CLO transaction highlights that some managers have very large balances held with the 20 largest entities. Manager exposure ranged from 27 million to over 2 billion, with most managers holding less than 500 millions in loans to the 20 largest entities. However, say that there are 9 managers that hold over 1 billion of loans to these large issuers. These managers with the greatest holdings are partly as a result of the large scale of their total assets managed across all their CLOs. However, on a percentage of asset managed, this is not always the case, as highlighted by, for instance, Signet Capital holdings of only 59 million and Cross Ocean 303 million, yet they represent 18% of their assets. Further, manager level details can be found within the report. But while the exposure to the 20 largest issuing entities can be large, exposure to any one individual entity would be limited to the CLO documentation limits, so the 3% and 2.5% that we were mentioning before.
Right. Now, as we've highlighted at the beginning, refinancing or repayment of debt maturities is an important event for companies heavily reliant upon credit. So, out of these large companies, how many of them have upcoming maturities that could potentially cause a refinancing event?
Yeah, in doing our investigation, we found that in 2025, next year, there is a larger exposure to refinancing challenges than originally expected. Given that a company can have multiple loans outstanding with varying maturity dates, upcoming individual maturities only present part of the picture, as the risk of a single loan struggling to be refinanced or repaid exposes the entity and all of its borrowing. Bringing forward the total outstanding borrowings of an entity to its earliest maturity date presents a different picture than just exploring the upcoming loan maturity wall. When examining the market on this basis, 2024 and 2025 present a larger near-term wall with nearly 3 billion of total borrowing facing a 2024 maturity and euro 20 billions of borrowing exposed to a 2025 maturity, as well as euro 40 billion in 2026.
Okay, so who are the borrowers with these larger exposures that are coming due?
So the entities that face upcoming maturities in 2024 and also have a large amount of total borrowings are relatively small borrowers within the overall leveraged loan market. They include Telecolumbus, Matterhorn Telecom, and Oxia, all of which are not insignificant but should be manageable. However, in 2025, there are a number of maturities that expose the market to some of the largest borrowing entities. For example, Altice France is the largest borrower with a maturity in 2025, exposing the market to its entire borrowings from CLO manager of around 2.2 billion. Altice financing entity also has a 2025 maturity and a total outstanding amount within the CLO market of 1.8 billion. So other large borrower in 2025 maturity includes Nida Healthcare Holding and Ineos Group.
Okay, so outside of Altice, are there any concerns with regards to these entities that you've listed?
The entity with refinancing coming due in 2025 have actually a modest K worth, largely remaining below 3,000. Most of these entities have a K worth equating to a single B rating. Ineos Group has the lowest K worth, equivalent to roughly a double B rating. Both with the highest are Altice France and Garfunkelux Holdco 3.
That is very interesting and brings to the surface some issues that I'm sure many investors were unaware of. Thank you very much, as always, Gabriele. While the CLO market is broadly diversified, the increasing number of large borrowers in the market expose both individual CLOs as well as CLO managers to idiosyncratic risks. As we highlighted in our conversation, in the current environment, the pressure placed on borrowers with elevated interest rates and margin pressures from increased input costs can cause challenges when it comes to refinancing. The CLO market appears to have little refinancing risk in the near term, although there is greater exposure than would first appear on the surface. However, for those borrowers that do have near-term maturities to refinance, they are all relatively well-rated companies for a leveraged loan borrower. Further, European CLO structures generally limit the exposure of any single obligor. That's it from us today. As always, we hope these conversations in credit help to illuminate the many trends taking shape across the markets. For more in-depth coverage of the themes discussed today, or to learn more about our unique approach to credit, sign up to the KBRA website to read all our research. Have a topic idea or comment you'd like to share? Reach out to me or one of the KBRA analysts on today's episode. Be sure to rate, share, like, and subscribe to this podcast so you can be notified when new content is available. Invite your colleagues as well. We'd love to count you all as informed listeners. This is Gordon Kerr, thanking you for being part of the conversation. Take care, everyone.